7 days or less on average for all the tenants that you have for the year, then you do not have a rental activity under Section 469 of the code, which sounds a little weird because the short-term rental is definitely what I would call a rental activity. But under Section 469 of the tax code, they say it's not a rental activity. Now, why is that relevant? Because in Section 469, that's where you find real estate professional status. So this is all tied together. So if you don't have a rental activity under Section 469, then you don't have to qualify as a real estate professional in order to make that rental activity non-passive. And that's really what the game is about at the end of the day, because all rentals are by default passive activities. And if my rental produces a loss, it's a passive loss by default. The only way to get around that, there's a couple ways, but the main way to get around that is qualifying as a real estate professional. And I recharacterize my passive loss as a non-passive loss. And a non-passive loss can offset my W-2 income. If I own a business, can offset my business income, because my W-2 and my business income are non-passive. I'm actively participating in them. I'm materially participating in that activity. So it's a non-passive bucket. So we have two buckets of income: passive, non-passive. The tax code says all rentals are by default passive. The only way around that is to qualify as a real estate professional and also materially participate in the rentals. But if I have a short-term rental that under that code section is not a rental, then it's not by default passive, which means that I don't have to qualify as a real estate professional to make it non-passive. I just have to materially participate in the activity to make it non-passive. So what a lot of our high-income clients will do is they'll come to us, and I'll walk them through real estate professional status and how challenging it actually is at the end of the day. And once they accept that, they go, "Oh, this is a real big bummer because I'm not gonna be able to hit real estate professional status for a long time. And neither is my spouse, just not gonna happen." And I get the whole Warren Buffett approach, adding a couple rentals a year. And over time, after 10 years, I've got 20 rentals, 10K a month in cash flow, and that's great. But I'm a really impatient person and I want tax savings today. How do I get it? And then we say, you can invest in short-term rentals. And if you self-manage the short-term rental, you will be materially participating in most cases. So you buy a short-term rental, you do not get a property manager for at least the first year, through the end of that first year. And if you can rent it out at least twice to get that average stay of 7 days or less, then you have a non-rental activity that if you've self-managed, you're likely materially participating in, and now it's a non-passive activity. And then you run a cost segregation study, you boost the loss, you've got a bigger non-passive loss that you can use against your W-2 income and anything else. So really nice way, really nice loophole to utilize losses from if you feel like that's what you need to do. I don't have to keep the short-term rental short-term forever. Next year, I can put a property manager on it. I can make it long-term. Doesn't matter. In the current calendar year, it was a short-term rental. I self-managed it. That's all that matters. And now I've got a non-passive activity. Really cool way to get around it. Now, one of the questions was, does it still count for real estate professional status? And so there are two tax court cases, one in 2001 and one in 2011, that said no, they do not count as real estate professional status. So if you go read my guide, the guide that we produced today, I believe that we actually call that out, reference those two tax court cases. But one of my senior tax associates at the firm asked me about 2 weeks ago. He was like, "Hey, why? So if I have a short-term rental, I get that it's not a rental activity. I get that there's a grouping election that you can make. You can't group short-term rentals with long-term rentals for that election. So I get all of that. What I don't get is why a short-term rental still wouldn't qualify as a real property trade or business for the purposes of real estate professional status, our testing." And I was like, wow, that's a really good question. So we go together, we start reviewing those two tax court cases in detail, and we realize that in those two tax court cases, the judges actually ruled incorrectly. Now, we thought that this was a little bizarre, and then we were like, we're probably just crazy. So we reached out to another guy in the industry. His name's Tony Nitti. If you've ever Googled real estate professional status, he's the one that has that tax advisor article. It's huge. It's kind of like ours, a little bit like ours. So I reached out to him, and he was like, you've got it right. So the two tax court cases that we were referencing were wrong. The judges were wrong on their ruling. They didn't understand how everything tied together. And then September of this year, the end of September, there was a new tax court case that dropped that confirmed this, everything that I'm talking about. So basically, in summary, your short-term rental activities do count towards real estate professional status hours. They can count towards real estate professional status hours. But you do not need real estate professional status in order to take the losses from a short-term rental. So it's
Very
like best of
interesting.
both worlds.
Yeah. Talk a little bit about, I've heard you and others say over and over that the real estate professional status is the most litigated area in the tax code. Can you speak to that a little bit? You know, you mentioned several different rulings and things there. What can you tell us about real estate professional status in terms of kind of how it's viewed and the litigation and that sort of thing?
Yeah. So real estate professional status, that is true. It's one of the top litigated pieces of the entire tax codes. There's tens of thousands of pages in the tax code, and real estate professional status comprises like 10 paragraphs. And it's the most litigated 10 paragraphs of the entire code. Now, where am I coming up with that? Well, there's about 500 tax court cases on real estate professional status, and that's the most out of any code section that's out there. But what those tax court cases give us, they give us a lot of clarity. So what I like to tell people is real estate professional status isn't that gray. It's relatively black and white. The thing that makes it gray is that it's always based on your facts and circumstances. So one thing that I always explain to people is education and research hours just don't count. And I can point to 15 tax court cases to show you that education and research hours don't count. And when I say that I can point to 15 tax court cases, what I mean is if we pulled up the rulings, the judges specifically say education and research hours don't count. But if you came to me and you said, I've got 200 rentals and I just went to this course or something and I did 40 hours of studying on how to manage my assets better across the 200 rentals, do those hours count? That's a facts and circumstances thing. I would probably say in that case, yeah, but also you don't need them because you're managing 200 rentals. So you probably already hit 750 hours or more than half your time. So it's a weird kind of dichotomy there, but highly litigated. You definitely don't want to play around with this code section. And the number one thing that I try to tell people is if you like read our guide and your tax advisor is telling you something different, ask for a citation. Always ask for a citation because one of us is wrong. Right? It's relatively black and white, and you should always ask for a citation and don't be scared. Hey, do you have a code citation? What tax court case are you getting this information from? I'd love a chance to review it.
Is there a place like on the IRS website or something like that where like links to these court cases or citations are for people to review directly? Are they kind of publicly known or?
So Cornell hosts the Internal Revenue Code.
Okay.
It's funny. One time I posted a link in I think it might have been like the Bigger Pockets Facebook group, and somebody commented and was like, any CPA that posts a link to some public school shouldn't be trusted. And I was like, well, that's where it's all hosted, literally.
Okay.
Yeah, it's all hosted in Cornell. If the way to find this stuff, so real estate professional status is in Internal Revenue Code section 469. So if you Googled section 469, then you would come right to the Cornell code section. So you can go right to the source and you can read it.
Okay.
Now, there's the Internal Revenue Code that Congress produces, and that's section 469. And then there's Treasury regulations. So you always see like IRC section 469. That's the Internal Revenue Code. But then you'll see Treas Reg section. Those are Treasury regulations. The Treasury regulations attempt to explain the Internal Revenue Codes. They're a little bit easier to digest. So if you Google section 469, you'll see the Internal Revenue Code. You'll also see, yeah, there you go. You'll also see Treasury regulations as well.
Okay. All right. Very good. Let's jump into some of these questions. I'm just kind of looking through the chat here. People can either like raise your physical hand or like raise your hand on Zoom if you want to ask a question live or kind of engage in some conversation with Brandon. We would love that. Or if you want to type the questions in, I can read them out loud. Victor asked, I think Victor's referring to what you just talked about in terms of like the short-term rental change and the judge stuff. Is that going to be updated in your guide?
Yeah.
Okay.
Yeah, we're going to be working on we're working on an update now, so we'll be kicking it out sometime soon.
Awesome. And then Carla said, my short-term rental is a legit Schedule C business. I was told since it's a business and not a real estate investment as Schedule C, then it cannot count toward reps. It seems like that's in line Go ahead.
No, I would say that's incorrect. Real estate professional status, there are 11 real property trades or businesses
Mm,
that count towards the real estate professional status hours. Operation of a real property trade or business is one of those. I mean, I don't know, maybe you had somebody look at it and they've already done that analysis and they've realized for whatever reason that it's not a real property trade or business. But I mean, if you come to me with a hotel, because that's what I would call this, a hotel, that's a real property trade or business in my mind. So that's going to count towards real estate professional status, even
Okay.
if it's on Schedule C.
Okay. Um, Victor asked, can you discuss how recapture of bonus depreciation would be taxed, i.e. 25% ordinary income split or of both, with or without other passive losses in the year of disposition? And Brenda,
Well,
I'm sure you
so
can see the chat too, if it's helpful for you to read it.
yeah. So it's kind of a lot going on there. So I'll try my best. When you bonus depreciate a property, first off, let me start at depreciation just so that we're all on the same page. So depreciation is a Vantum expense that I get to claim every single year as a benefit of owning real estate. So I can buy property, I can cash flow 10,000 bucks, but then I could tell the IRS that I actually lost $2,000 because my depreciation in that example might be $12,000. So my 10K cash flow minus 12K depreciation, negative 2,000. That's what I get to tell the IRS. Now, I didn't actually spend money on the depreciation. That's just something that I get to claim every single year. And depreciation is meant to track the deterioration of your asset over time. So it's really nice, a really nice incentive for real estate investors. And that's what I mean by that Warren Buffett approach. If we come full circle here, the Warren Buffett approach to investing is let me invest in tax advantageous cash flow streams. And if you buy 10 rentals that all cash flow 120K collectively for the year, but I get to tell the IRS that I lost 150K thanks to depreciation, which is a Vantum expense, then my 120K of cash flow is tax deferred or tax free for that year. So depreciation, when I buy the asset today, every single year for 27 and a half years, I get to take a little bit of that purchase price. So the purchase price minus land divided by 27 and a half years, that's my depreciation on an annual basis. Doesn't matter if I put 0% down. Some people ask, well, what if I 100% finance the property? Doesn't matter. It's the purchase price minus land divided by 27 and a half years. That's my annual depreciation. The problem is when I sell the property, I have to recapture the depreciation that I've claimed or the depreciation that I could have claimed. Because some people go, well, I just won't claim depreciation. Like, that's a huge mistake, because when you sell the asset, the IRS is going to tax you on the depreciation you could have claimed, even if you didn't take any depreciation. So you always have to take depreciation. But when you sell it later, you're going to pay a tax. It's a 25% tax on the depreciation that you have claimed or could have claimed since you own the asset. Now, some people do something called a cost segregation study. And a cost segregation study is the practice of saying, okay, I bought this property for $100,000. And the IRS says that I have to depreciate it over 27 and a half years. But I know, and you know, that all the stuff inside that asset is not going to last 27 and a half years. I've got carpet, I have appliances, I have cabinetry. It's not going to last that long. So a cost segregation study is the practice of saying, we're going to take that $100,000 purchase price, and we're going to allocate it to property with a shorter useful life, personal property and land improvements. And they have 5-year schedules, 7-year schedules, and 15-year schedules. So what I mean by that is we're taking money out of this 27 and a half year depreciation bucket. And we're putting it into a 5-year bucket, a 7-year bucket, or a 15-year bucket. So if we think about $10,000, if we allocate $10,000 out of that 27 and a half year bucket and into the 5-year bucket, if it's in the 27 and a half year bucket, we're looking at, $2,800 a year in depreciation. No, that's too much. Sorry. Whatever that comes out to be, it's not very big. But when I move it to the 5-year bucket, now I get $2,000 a year in depreciation for 5 years. So if it's in the 27 and a half year bucket, I think it's like $500 or something a year, $10,000, $500 over 27 and a half years. Then if I put it in the 5-year bucket, now I get $2,000 a year 4 or 5 years. After that, I don't get anything else. So I've fully depreciated it. So cost segregation study, that's the practice. It's moving the value out of the 27.5-year bucket and into the 5, 7, and 15-year bucket. With the 2017 Tax Cuts and Jobs Act, we now have 100% bonus depreciation, and that allows us to immediately expense any component with a useful life of less than 20 years. Now, all of a sudden, a cost segregation study is something that's valuable. If I can move value out of the 27.5-year bucket, which is more than 20 years, so not eligible for 100% bonus depreciation, if I can move that value into 5, 7, and 15-year buckets, which are all less than 20-year property, then they all qualify for 100% bonus depreciation. So when I do that move, when I do that cost segregation study, I get to claim 100% bonus depreciation. When I have to come full circle to Victor's question here, when I sell that property later, I have to recapture that bonus depreciation at my ordinary income tax rates, okay? Not 25%, because it's depreciation that's been accelerated over straight line. So I hope that kind of helps, Victor.
Thank you for answering that. I like how at the end you're like, okay, to get back to the question. That's excellent.
Yeah, sorry.
These are detailed, tough questions. I love that you guys are bringing up, very specific situations. I'm going to read some of the questions that were posted in the Facebook group when we announced this. Especially this one, because I think a lot of people have questions about this. How do you structure your property ownership for taxes? An LLC helps with anonymity, but doesn't help with taxes.
Correct. Yeah. So it does not matter how you structure your entities. It's not going to help you for taxes. It's not going to make it better. The only thing that you can do is make it worse. So don't think that putting my property into an LLC is going to give me these tax write-offs. The only additional tax write-off that you will get by moving it to an LLC is writing off the LLC's annual registration fee, which you didn't have that expense prior. So that's the only big tax benefit, or the only tax expense that comes with the LLCs. What I would say is avoid corporations, S corporations, C corporations, for holding the rentals. We have some clients that run a property management company out of an S corporation or C corporation. The corporation itself doesn't own any rentals. That's fine. But for the most part, keep it simple. Unless your attorney is like really convincing you that you need to not keep it simple, keep it simple. LLCs are fine. We can always tax the LLC as an S corporation or C corporation at some later point. We can file an election and we change the character of the entity. So LLC is the go-to. They're very flexible, very easy to set up. They're easy to move property into. There are rules against moving property in and out of LLCs. You do have to touch base with an attorney on that, especially if you have debt. You got to look at local transfer taxes in your states or your localities, so be aware of that as well. But just keep it simple. Get the LLC. We see a lot of clients that'll come to us with one property and they've got an LLC, a trust, and a C corporation all set up. And I'm just like, okay, well, that's great. But now we have to file taxes for all these entities and you only have one property. And like, what are we really doing here? So just keep it simple. You got to get the asset protection, but focus more on the simplicity, at least at the beginning.
Can you take just a minute? I don't want to get too far away from specifically talking about real estate investing, but can you take like a minute or two and explain just very briefly what an S corp and a C corp is and why a real estate investor wouldn't want those?
Sure. So an LLC is a limited liability company, not a corporation. A limited liability company. An LLC can elect to be taxed as an S corporation or a C corporation. On the other side, you have a C corporation that can elect to be taxed as an S corporation. So you can never just go set up an S corporation. You have to either set up an LLC or you have to set up a C corporation, and then either one of those entities can elect to be taxed as an S corporation. So the issue with corporations and owning rental real estate is primarily around estate planning. When you die, your children get at least today, your children get a stepped up basis in your assets. And when you own your real estate inside of an LLC, what happens is we look through the company, through the LLC, directly to the asset that the company owns, and your children get a stepped up basis in that underlying asset. So if I bought a property for 100K and then I die and it's worth 300K, my son gets to own the asset for $300,000. That's his basis. So he can go and sell it immediately and pay zero tax, or he can start depreciating it at $300,000. So he gets a stepped up basis in the property. When you put property into a corporation, you don't get a stepped up basis in the underlying property. You only get a stepped up basis in the corporation's stock. So that's the difference. That's the huge difference for LLCs and corporations. The LLCs, we look through the company and we go right to the underlying asset. When we have corporations, we look at the stock only, and it creates a lot of complications around valuation. How do you value the stock? It creates complications if the corporation itself sells the asset, because it's going to have a big gain. It doesn't get a stepped up basis in the asset. So we like to be really careful with putting, there can be good times to put rentals in a corporation, but it's relatively rare.
Okay, thank you. There's a question here that goes along with this. It's maybe a little outside of tax advice, but I wonder if you could speak to it a little bit. Does the multiple LLC really protect you, or what is a simpler way of doing the parent LLC and then a local LLC?
Yeah, so I'm not an attorney, and I'm going to probably dodge a lot of the asset protection type questions. What I can tell you from my experience is that there are attorneys that are very consultative in their approach. They will work with you one-on-one to figure out your risks and how much you're willing to pay for those to reduce those risks. There are also attorneys that have everything templated out. And there are pros and cons to using both. There are pros to use the attorneys that are templated out because it's streamlined. Everybody's getting relatively the same thing. And that can be great as long as you fall within the bucket that is super beneficial for. Could not be great if you're on the high end or the low end of people that fit into that bucket. And so the question is, are they going to tell you that, and they're going to consult with you on it? And that's the question. I think what we have seen is that people come to us with entity structures that they just don't need. Need is always subjective, because you might be somebody that just is scared to death about getting sued. And you've got one rental property and it's totally not economical for you, this elaborate entity structure. But if it helps you sleep better at night, then by all means, go for it. Go for it. But you always have to think about entity structuring is insurance. That it acts as insurance. So whenever you go buy any sort of insurance, you can always buy the insurance that protects you from 99.9% of all things for $800. Or you can buy the insurance that protects you from 150% of things for $5,000. And so you have to just decide, what insurance level do I want to reduce my risk? But we see a lot of people get excited about entity structuring. They get excited about having corporations and all this cool stuff. But I always tell people, ask what the ongoing preparation costs are going to look like. Because when somebody comes to me with 5 partnerships in a C corporation, I'm going, great, we're going to charge you $12,000 a year to prepare these. And then they go, whoa, wait a second, I only have one rental. That's more than my cash flow. So just be careful. Just make sure that you ask questions up front, get the full picture, and it could be totally worth it for you because it is all subjective. But yeah, just be careful.
Very good. Thank you. I'll do one more question from the stuff that was previously posted in the Facebook group, and then we'll do some of the live questions. I appreciate you guys putting questions in here. This is a good one. It's a simple one, but I think it speaks to some of the fundamentals of why real estate investing can be so tax advantageous. If you renovate and then rent out a property, can you deduct the renovation costs?
Maybe. So what we're talking about here is probably the de minimis safe harbor election. And here's why I say maybe. Because so the de minimis safe harbor, it came out with the 2013 tangible property regulations. And if you ever want to know how to save more money than you will ever save them compared to being a real estate professional, you go and learn the 2013 tangible property regulations. That's what we try to teach some of our clients. And it's all about, if I have an expenditure, is this a repair, which is deductible today and I don't depreciate it? Or is this a capital improvement that I depreciate over time? And then whenever I sell the asset later, I have to recapture the depreciation on that capital improvement. So the idea is try to deduct today as repair so that I don't have to sell later. Part of the 2013 tangible property regulations is something called the de minimis safe harbor. Now, when the de minimis safe harbor was written in Congress, so when it came out, The threshold was $500. It was $500 per item on the invoice. The idea of the de minimis safe harbor was to allow easier tracking for your books and records. So it's a book conformity rule. It's not a tax freebie rule. And that's a critical component, because what that means is you can't go and take the de minimis safe harbor if you don't have bookkeeping that matches your tax return. So you can't have bookkeeping that, or if you don't have bookkeeping at all, then you can't go take the de minimis safe harbor, because it's a book conformity rule above all else. But what happened was Congress put this out and said it's a $500 cap unless you have applicable financial statements. Think about like publicly bigger companies that get audited and things like that, which is very few people that we know of. So we were all focused on this $500 cap, and you can deduct anything under $500, no questions asked. Well, then they increased it to $2,500 later. So the issue was that and this is why I say maybe, because if it stayed at $500, there would be no issue. You wouldn't be able to deduct your rehab costs. What rehab you're going to be, even if you itemized everything, it's going to be really tough to say, yeah, everything falls within this de minimis safe harbor. The problem was when they increased it to $2,500, all of a sudden the question was, well, now can I deduct my rehab costs? Because I can fit things under $2,500. Sure. You can split materials and labor up on separate invoices technically. So it's a maybe, because I expect tax court cases to come out over the coming years that give us a lot of clarity on how these rules are supposed to actually work. I think that it was not the intent of Congress to allow everybody to deduct their rehab costs up front. And what that means, if it's not congressional intent, then there's going to be tax court cases where the IRS argues that that was not the way it was supposed to be. And we'll just have to see how it all kind of plays out. We have clients that we feel comfortable for the most part doing it. For most cases, I should probably back up a little bit. We can feel comfortable if your facts and circumstances make sense. There's nothing that technically says that you can. There's nothing that technically says that you can't. So what we try to do is just explain to the client that this is going to be risky. And are you willing to accept that risk?
Very good. Thank you. Going to our live questions, we have a question from Liz. I own a second home that my aunt lives in for free. We have extra bedrooms. Could we Airbnb some of those, and I can manage it and do cost seg and deduct from my active income?
I wouldn't if you live there. Do a cost segregation study. Was that they live there too, or some of it's personal use?
Liz, feel free to unmute and.
Yeah, no, I don't live there. My aunt lives there, and I'm letting her live rent free because she has no income. So it's like a second home, and it's sort of a rental, but sort of not a rental because I'm letting her live there rent free. So one of my financial advisors had suggested like I could gift her the rent. Anyway, it got so confusing. I couldn't deal with it last year, but so anyway,
Yeah.
But this idea of doing Airbnb, because I thought about doing that when I first bought the property 5 years ago, is that would be a way we could generate income, because she's not paying me, the $20,000 a year it costs me to pay property taxes and
Yeah.
all that stuff. But I thought that would be a way to generate some income with the property. And now that I'm learning about what you just said about, the Airbnb, and then I could actively manage it.
Yeah.
But she'll be there to help me out, honestly. Don't quote me on that. But then could I use that to create, to do the cost seg that you were talking about at the beginning of the call?
Yeah.
That would allow me to apply some of that to, basically to apply those cost seg deductions to my physician income.
Yeah. A lot of really good questions in there, and a lot of things to explore. So let me try to summarize it for you, but I would encourage you to explore it further. So first things first, you said that you bought it 5 years ago. If you cost segregated at this point, and you apply it to 2020, I believe that the bonus depreciation is going to be either 20% or 0. Any property that you purchased prior to September 28th, 2017 had a big phase out of depreciation very quick. Like if you purchased it before that date, but then put it into service as a rental after that date, the bonus depreciation phases out real quick. So if you put it into service in 2020, I'm actually not sure what number that is, but it's going to be low. So that's the first thing. So probably from that alone, I wouldn't recommend that you cost segregate it. The other thing that you have going though is it's not a rental if you have somebody staying there that's paying under market rent. So that would be personal use, and it would count as your personal use. So it's a second home, Schedule A. You are right to not go and like gift the rent back and have them pay you, because that would be blown up in an audit. So I wouldn't do that. What I would do is, if you wanted to depreciate anything from this property, if you wanted to create income that was tax deferred, meaning that the depreciation will help you offset it, I would think about renting out some of the rooms. And you can do that, but when you report the property, what we'd have to do is say you've got some personal use, because your aunt's not paying rent, so that's personal use. So what portion of the property does she occupy? Maybe it's 30%. So we're only going to report 70% of this property as a rental. So 70% of everything there can be depreciated. The furniture can be 70% depreciated, like anything like that. So there's opportunities there, but probably not to the extent where I would tell you to go nuts with it. Like you could definitely generate income and not pay tax on the income. And that's if I were you, that's where I would try to optimize it, is can I rent this out for 20 grand a year and not pay tax on the 20 grand?
Kind of getting back to that Warren Buffett.
Yeah.
Yeah. That this question is similarly related to a question from Jessica. I'm going to read her question and then kind of ask a more general question. I have 2 properties that are currently rented to family members, but under fair market value. Can I deduct anything from these properties with my W-2 income? So I was wondering if you could specifically speak to Jessica's question, but then also in our real estate investor physician group, it's not uncommon. I would say, maybe 10 times a year, someone will say, my parents are getting older, or some loved one, and I'd like to, I'm doing well as a physician, and I would like to buy a house and allow them to live in it, maybe for free or maybe for a drastically reduced rent, and kind of what would the tax situation on that be? So very similar to Jessica's situation there.
Yeah, absolutely. So whenever you rent to a family member, or really anybody, if you're renting to somebody and they're not paying fair market rent, then you do not have a rental. You just have a Schedule A property. It's second home. And that goes for family, goes for children, goes for parents, grandparents, aunts, uncles, anybody that you're renting to and they're paying under fair market rent. You do not get to report it as a rental, so you don't get any of the tax deductions associated with it. You also aren't reporting the income that they're paying you, though, because it's not rental income. So pros and cons. You can have a family member stay and lop off about 10% of the fair market rent for them, like a good tenant discount sort of thing. But
where is fair market rent determined?
You would have to substantiate that. So you can get a real estate agent to pull that information for you. You can talk to property managers, or you can go on to like rentometer.com and pull the comp information.
Okay. Very good.
Yep.
So what would the response be? Because I know over the next year, I'll probably get like 6 to 10 of these questions in the group of, I'm going to buy a house and my mom is going to live in it rent free. What's the tax situation? It sounds like it's a Schedule A.
Yeah.
Okay.
Property taxes and interest.
Okay. Very good. So that's similar to like an owner occupant home.
Mm-hmm.
Okay. Very good. One of the questions from Amy, this is a good one. Do I need to wait at least 1 year to sell a property or 1031 exchange to decrease tax?
Not necessarily. There have been tax court cases that have shown that you don't have to wait a year. What you do have to do is demonstrate investment intent, which is why people say you have to wait a year. So anytime that I 1031, the property that I sold had to be an investment property, and the property that I buy also has to be an investment property. So I can't 1031 into a primary residence. I can't 1031 out of a primary residence. I can't 1031 into like a flip or development property or out of a flip or development property. So it has to be investment intent. But there have been a ton of examples in the past where people have, they bought a property and 3 months go by and they just get this once in a lifetime deal. Somebody hits them up and says, I'll pay, I bought it for $1 million. This literally happened to one of our clients. He bought it for, it's like $1.2 million. A month went by and he got an offer for $1.9 million. Now, he didn't know that was going to happen. It was unsolicited. He wasn't advertising it. So that was something that he could 1031. It was all investment intent. He was going to hold the property for 5 years. So all of his modeling said, just happened to fall in his lap. So that's a 1031 exchange property. On the back end, the intermediaries are trying to reduce their risk. So they're going to tell you, you have to hold for 12 to 24 months, which is not wrong. If you want to demonstrate investment intent, you need to hold the property or rent the property for an extended period of time before and after the exchange to be safe and not have the exchange challenged or blown up in tax court. But it's all about intent, not necessarily the time.
Mm-hmm. Very good. What about this question? This was one of the ones that was pre-submitted. Any ideas on how to use up suspended passive losses without reps? And if you're over the 150,000 threshold, any clients that have passively invested in cash flow positive businesses or other ways to generate passive income, pigs against pals?
Sure.
I'll put that in the chat for everyone to read.
Sure. So remember what I said earlier. We have two buckets of income. We have the passive bucket and we have the non-passive bucket. Now, all of my passive income and loss can offset each other. So it's all in one big bucket. And I always hear sometimes like, oh, my CPA says that can't be done. And I say, that's phooey. Go to form 8582 on your tax return and have them fill it out. And they will see that they all offset. So if I have a lot of suspended passive losses, let's say I buy a rental property and I cost seg it, and then I realize I can't take the loss. So I'm stuck with a $50,000 loss. It's a passive loss. It becomes suspended. And no, if I qualify as a real estate professional in 2021, no, the $50,000 suspended passive loss does not get unlocked. We've seen people try to say that, and that's not how it works. It stays suspended, and it can only offset future income from that activity if you are a real estate professional going forward. But if you're not a real estate professional, then that suspended loss can offset any other passive activity, any other passive income. And what people will do is they will go buy stakes in businesses. So if one of you came and you're like, Brandon, I want to invest in your CPA firm, I would say, cool, but I'm the type of business owner that I don't let anybody else make decisions. So I would say, you can give me money and you can have a 5% stake, but you're a silent partner. You're not contributing. You're not voting. You get no rights. Be like, okay, that's fine. Now the income that I generate for you, even though it's considered ordinary income, even though it's business income, to you, it's passive income because you're not participating on an ongoing basis. So you can go buy a rental property, create the depreciation, the losses, and use that to offset the income that I give you because you're passively involved in my business. I hope that kind of makes sense. So yes, you can invest in businesses. There are specific types of businesses that are considered passive income generators, PIGs for short. But really any business will suffice as long as you're not materially participating.
So like if a physician owned their own practice or owned their own surgical center or something, that wouldn't count because they would be actively involved.
Yep.
But maybe if they're invested in, like I'm a psychiatrist, but if let's say I know a surgeon that I trust a great deal, I invested in that surgeon's business and got some return, then that would be PIGs.
Mm-hmm.
Okay. Mm-hmm. Very good.
Great
I know
question.
that's a question that comes up quite a bit. It's good we were able to get to that.
Yeah.
Let's see what other questions we have. This is a good one. Does travel time count toward real estate professional hours? What if the rental is out of town? If you do your own bookkeeping, does that count toward rep? So let's start with travel time for an out-of-town rental.
All right, so travel time. So the IRS audit technique guide on passive activity losses. And the audit technique guide, the IRS has tons of audit technique guides. And what the guides are is they are the field auditor's guide on how to go through an audit with you. So what questions to ask, what the terminology they should use is, and what theories they should be testing. In the audit technique guide for passive activities for the IRS, they say that travel time does not count. Okay. So that's the IRS's position. Travel time does not count. Now, tax court cases in the past have gone both ways. There's one tax court case, Lay versus Commissioner, where she was about, I think, 75 hours short of real estate professional status. She had testified and through the testimony, she proved herself to be a very credible person who was legitimately managing her own properties, legitimately running this real estate business. And the tax court said, go back and count your hours for your travel time. And that put her above the 750-hour test. And the tax court upheld that and said, you are a real estate professional. But there have been other tax court cases. There was one, I don't remember what the name of it is off the top of my head. I think it dropped earlier this year. And they said travel time is not actually participating in the rental activity. And because you're not actually participating in the rental activity, when you're driving to and from the rental activity, it doesn't count. So you just have to realize that the IRS is going to say no. Tax court might go either way. So if you come to us and you've got hundreds of hours of travel time, we're going to tell you, you got to figure something else out because this is too risky, way too risky.
What if you're living locally and you're managing a property, say 30 minutes away, and you drive 30 minutes, you have a 30-minute meeting with your tenant, I don't know, you fix a sink or something, and then 30 minutes home. Do you get to claim the 30 minutes you're working on the sink or the 90 minutes for the half an hour travel side?
Well, you definitely get to claim the 30 minutes that you're there doing the repair. We would tell you to record the entire thing anyway. So we're never going to tell you don't record the hours, right? Like even education and research hours, still record them because we want you to be a very credible person whenever they're reviewing. We want that log to be really credible, meaning that you go through and you've documented every single little thing that you've done. But if I look at the log and I see, oh, we've got a lot of this travel time, this is high, this could be pretty high risk. That's where it comes from. So to answer your question, we're going to say record it. Now, the question is, will the IRS accept it? They're going to take the position no. But in Lay versus Commissioner, that was kind of that exact sort of situation. She had a bunch of rentals that were close to her, and she was traveling around between them on a daily basis. And so the tax court was like, look, you're definitely materially participating because you're doing this on a daily basis. If you didn't do it, the properties would fail. So that's what I mean, where it kind of comes back to facts and circumstances. So if I'm not doing this, will the properties fail? Will they cease operations? If I go and buy a property that is 300 miles away and I have to take a plane to get there and there's a property manager managing it, my travel time probably doesn't count in that type of case.
Okay, very good. Brandon, we are right at about 3 till the hour. Are you okay going maybe 15 minutes over since we kind of got started late with thanks to the Facebook and technologies?
Sure.
Why don't we have a couple other questions here, but I think just kind of thinking about the activity in the group and kind of the questions that are routinely asked in the group, and I was able to start the recording here. I'm wondering if we could kind of just take like a big step back. I know we talked in the beginning about ways that a high income person can get really good tax benefits from real estate investing, even if they don't have reps. But reps is a hot topic. Everybody wants it. Everybody's talking about it. Why don't we do, instead of like a Q&A, what do you think about you doing just like a 10-minute teaching on what do you tell someone when they call let's say they're a physician, maybe they're married to another physician, or maybe they're married to a stay-at-home spouse, and they say they would like to claim reps. What does that phone call look like? And then that way, when I post this to the group, I'll be able to tell people, go to the last 10 or 15 minutes. That's where the meat is for reps.
Yeah. So the very first question I ask, and I've learned to ask, is, are you a coachable person?
Okay.
Because if you are not willing to hear, then it doesn't matter what I tell you or anybody else. It's just, nope, I'm doing it this way because that's what I've been told and that's what I want to do. So to me, that is extremely risky. And it's risky because, and it's not me, like we are a pretty aggressive CPA firm. We will we only have to have a 50% chance of winning. in order to take a tax position. That's a long way, right? And we go right up to that 50% if we can substantiate it. So we'll take those positions all day long. But what I think, where I think there's been a big disconnect with real estate professional status is that it's easy to talk about because it's the fun thing to talk about. It's the thing that gets everybody excited. But what people don't realize is it's difficult to get, and it's highly litigated. And when you combine those two things and you don't set the proper expectations, what you do is you set a lot of people up for failure. So when people come to me and they say, I'm full-time physician, my spouse is stay at home, I go, great. We have an opportunity to be a real estate professional. Is your spouse interested in real estate? And this is assuming that that they are coachable, right? So I go, is your spouse interested in real estate? And they go, oh, not really. Okay, well then we're done. This conversation's over, because you're going to get audited, and your spouse is going to be the one that has to talk to the auditor, and they're not going to be able to use the terms. They're not going to be able to talk about it with any sort of detail, because I know what's going to happen. The physician or the main breadwinner, we actually get this a lot in the tech space. So the person that's bringing in all the income goes, oh, I'll just email on their behalf, and I'll just structure it, but I'll do it through their email. It's great, right, until all the cards fall, and then you're toast, because it's her or him that they're going to audit, not the person that's actually running all the deals. So we have to be really careful there. But assuming that they are interested, then it's just a matter of talking to them and educating them on, okay, here's the type of stuff that's going to count. Like, here's how you need to structure your facts and circumstances to make sure that if you do get audited, you can 100% substantiate that you are legitimately a real estate professional. And a lot of times you have to self-manage the property. You have to self-manage to some extent. I cannot have 5 properties that are fully 100% property management managed and expect to qualify as a real estate professional. We've talked to a lot of people over the past 2 years that are like, well, I'm going to go buy a $70,000 home out in the Midwest, get a property manager, I'm going to be a real estate professional. I'm like, nope, you're not. You just can't. You can't. The IRS is never going to accept it. So
what about,
if you're not going to self-manage the property,
things like
what's that?
What about managing the manager, like having those phone calls with the property manager, looking at the bookkeeping? Because full disclosure, my husband and I own a property management company. And so that's what people, say to me is, well, we want to, log all of the hours that we spend talking with you to count. And I've always thought, you're not actually managing the property, and it kind of worries me, but to speak to that.
Yeah. So the tax court has officially ruled multiple times that watching contractors is not time that counts. Now, this is a little bit different than watching a contractor, right? You're supervising the property manager, and supervising a property manager can definitely count towards real estate professional status. The problem is that it's facts and circumstances based. So if you have 5 properties and you're quote unquote supervising the property manager, I would take the position that you're not actually involved in the day-to-day management of your portfolio. If you have 30 properties and you're supervising the 30 property managers, I would probably take the position that you are you're significantly involved in the day-to-day management of your portfolio. So when we talk about bookkeeping, when we talk about filing tax returns, supervising the property manager, coordinating with the property manager, paying bills, all that stuff, the real question is, are you involved on a day-to-day basis in managing your portfolio? And if the answer is no, then none of that time counts. Bookkeeping doesn't count. Supervising the property manager doesn't count. The reason is if you're not involved on a day-to-day basis, all of those hours are lumped into a bucket called investor hours. This is in the IRS Audit Technique Guide. It's in multiple tax court cases. I've talked about it on that 12,000 word guide that we put together too. So if that's the case, then none of that time counts. And what that means is, for you, if I'm not going to self-manage my property, I need a lot of property. If I'm going to have property managers on, I need a lot of property, or I need to buy local and I need to rehab a property myself. Like, I need to GC it. I need to coordinate it. That's a way that you can sink a lot of hours into rental real estate. So you got to come up with a different strategy. But the lazy man way is, I'm going to invest out of state, 200 miles away, get a property manager, and then claim that I'm a real estate professional because I've got education hours. I researched it for 200 hours, and I'm supervising the property manager, and it takes a lot of effort to supervise the property manager, who probably knows more about property management than you do, but I'm going to supervise him anyway, and we're a real estate professional, and tax court will just eat you. So I wouldn't recommend it.
What are some of you've mentioned this phrase like day-to-day activities of property management. What are some of those things? What are the, say, top 5?
Yeah. Advertising, structuring leases, coordinating with tenants, handling maintenance requests, doing the maintenance requests, doing the repairs. It's stuff that a property manager would do. If sometimes people ask me that, and I say, I encourage them to call a property manager they know and ask them what their job entails. And that's what it is. And it's important to understand, because typically when we get to this part of any real estate professional conversation, we start to lose people because they go, oh my gosh, well, this is actually a lot harder than I thought. And it is. And that's the entire point of it. Because before 1986, physicians were getting away with murder on rental real estate. That's the entire reason that this code section exists. That's the entire reason.
I recently have spent a lot of time learning about 1986, the year of my birth, but learning about it because I feel like it's kind of happening again.
Yeah.
Speak a little bit about, for people that maybe are just learning about reps for the first time, the 750 hours, the material participation, and 51% of economic activity. I think that'll be high yield for a lot of people to learn about that.
Yeah. I was laughing at Reagan's question. That's funny. We'll talk about that in a second. So real estate professional status. So if we take a step back, Section 469 implemented in 1986, because before that, people would be running physician practices. They'd be in the tech world, earning a ton of money, and they would invest in real estate, accelerate their depreciation, and not pay tax. So Congress basically said it's not fair for somebody that's not actually running a real estate trade or business to be able to utilize this tax shelter. So they put in Section 469 to stop all of that. And then later in 1994, they added the real estate professional status section because for a variety of reasons that we don't have to jump into. So the real estate professional status, so what Section 469 did is it said all rentals are by default a passive activity, and you can only claim passive losses against passive income. So if you're able to go through and create this huge passive loss, you can't claim it unless you also have passive income or unless you sell one of your passive activities. So that was what Section 469 did, created these two characterizations of income, passive and non-passive. And in order to recharacterize rental real estate from a passive activity to a non-passive activity, I have to qualify as a real estate professional, and I also have to materially participate in my rental real estate activities. To qualify as a real estate professional, I have to spend 750 hours of personal service hours. This is in the code, personal service hours in a real property trade or business in which I materially participate. I also have to spend more than half my time in a real property trade or business in which I materially participate compared to all of my other activities. So that immediately kicks out anybody with a full-time job because they can't spend more time in real estate than they spend in their W-2 job. But it also kicks out people who are not actually materially participating in their landlording business because it says 750 hours, personal service hours, real property trade or business, material participation. So sometimes we get people that go, well, I could spend 500 hours in my rental real estate and then 250 hours of anything else. And that's not true. It's 750 hours of material participation because there's this confusion of there's 7 tests for material participation. One of the tests is 500 hours. And so people think, well, if I just spend 500 hours materially participating, then I still have to get that 250 extra to hit 750 for my real estate professional status election. So that those extra 250 hours can just be anything, and that's not how it works. It's every single hour is a rep hour and a material participation hour. They're one and the same, and you have to spend 750 real estate professional hours. So if you're only a landlord, that's the only real property trade or business you have, those material participation tests, just toss them out the window, act like they don't exist. Your target is 750 hours of material participation. Does that help?
It does, yeah.
Okay.
You've mentioned several times this like audit guide or something where like the field auditors use it. Can you speak a little bit about what does an audit look like if someone and I guess let's stay focused since we just have a few minutes left. But if someone is claiming real estate professional status, what would an audit look like? How would that person find out about it? And then what is this audit guide?
Yeah. So you'll get a notice in the mail. It'll be a letter, and it'll be a letter that says we are examining your returns. and we're examining them for these reasons. Now, if you ever get a letter in the mail, you should not reply to it. And the reason you shouldn't reply to it is because you might send back a little bit more information that's necessary, and all you've done is just expanded the scope of the audit. So make sure that you talk to the CPAs, because like what we've learned to do is it's just very literal. It's if they've requested this one bank statement for this one account for these 3 dates, then that's all we're going to give them. I'm not going to send back a bank statement for the entire month because that expands the scope of the audit. So you get a letter in the mail, and I always tell people, don't panic. If you're investing in real estate, you will get the letters. You will all just get used to it. You'll get the letters, and I know your heart drops because I get letters in the mail too, because we represent people. And so the IRS has to mail me like an actual letter saying, we've got your representation. Every time I get that letter, I go, oh God. so it even happens to me. So I get it, but you have to take a step back and realize this is part of the game at this point. So you'll get a letter in the mail, and it'll say, we're examining your return. And then you have to respond to that letter. Most audits are written. They're a correspondence audit. So you just write a letter back with support, and then you're good to go. Sometimes that letter will say, we want to meet in person. And when they want to meet in person, you need to get a tax attorney. We would probably even tell you, get a tax attorney, and we'll help you find a tax attorney that's local to you that can house that, or that can handle that. So that's how that process starts. Once you're there, though, I mean, they're just going to ask you about everything. And I've got you can look all of this up in the audit technique guide. So if you are actually getting audited, you should go pull the audit technique guide up to understand what they're going to ask you. But they're going to ask you about your personal life. Elizabeth, you said that your aunt was staying there rent-free. They're going to ask you, is anybody staying at your property rent-free and helping you manage the property? So they're going to go into detail. They're going to ask you about, what do you do for your social activities? What do you do for fun? What charitable organizations are you involved with? Because what they're trying to do is they're trying to prove that you can no way have the time to materially participate in your rental activities. They're going to try to prove that. And in assuming that they feel confident that they are able to prove it, and you also feel confident that you're able to prove that you are a real estate professional, then the next step is tax court. And then it's just a game of who's more credible. That's all it is. It's not these tax court judges do not live in bubbles. And there was actually a tax court case where the judge wrote, we don't live in bubbles. So these are guys that you're going to invite over, or even women that you'd invite over to like a Sunday football game to hang out with, or you go on a walk with, or go to the park with. They're ordinary people. So how are you going to convince your friends that you're legitimately a real estate professional? And that's the question you should really be asking.
You know, that speaks to, I'm not a CPA, I'm not a tax attorney. I just invest in real estate, get a lot of questions about reps, and kind of the really simple thing I've been telling people, especially fellow physicians, is in a pre-COVID world where we have dinner parties, if you sat down with let's say a table of 12, you're at a wedding and you don't know 11 of those people, would you introduce yourself as, my name is Elaine, I'm a real estate investor, or my name is Elaine, I'm a psychiatrist? And kind of,
it's a good way to think about
it. That, if you can kind of like wrap your mind around that, and if your friends are introducing you, oh, this is so-and-so, he or she's a real estate investor, it's probably like a 10-cent test that can go pretty far. In terms of this audit guide, I found the audit technique guide for passive activity loss. Is that the one, Brandon? I'm going to drop that in the chat then for people. Let's end on this kind of silly question, because Victor, this is a curious, fun question. I presume that being president of the United States is a full-time job, since the president of the United States gets a 6-figure W-2 income that's greater than $150,000. Do you know if he qualifies to take so many real estate losses, or is the first lady, does she need to qualify for rep?
Yeah, well, I have no idea. I don't know. I was actually hoping that we would all be able to see the tax returns, so that I've been really excited about it. And when the New York Times came out and they were like, we got them, I was like, yes, we can finally take a look at them. And then it was just their interpretation of them. So I don't even know. The problem is that Section 469 is so incredibly complex that I don't really trust anything that the New York Times had to say about that. Not because I don't trust the New York Times, just simply because I know that Section 469 is incredibly complex. What I presume was going on was that there was a combination of tax credits and different losses that he was able to take on his development deals, or he had a ton of real estate losses that were passive, and however they did it, they recharacterized all of his regular operating businesses as passive. That would be the only other way, because if they're in the passive bucket, then they can all offset each other. So I don't know. I wish that a lot of people have asked, and all I can say is I really wish that I could have actually seen those tax returns.
Well, maybe one day.
Yeah.
Thank you so much for your time. This has been so helpful. I've put some of the links to some of the things that we've talked about here in the chat, and then I'll make sure to add those as comments to the Facebook group, as comments to this recording. How can people find you, Brandon?
You can go to therealestatecpa.com. We've got a big orange button that says become a client if you're interested in consultation. Or you can, I was gonna say email. You can email me. Yeah, let me actually post my email so that you have it. It's brandon.hall@hallcpallc.com. I might not reply to you. My executive assistant might reply, but if you want to get in touch, you can certainly do that. And if we didn't get to your questions here, feel free to ask. Like, I love Section 469 in real estate professional status, and I feel like our firm knows it really inside and out, kind of compared to all the other CPAs that are out there. So if you have any questions at all ever about that, feel free to hit us up.
Awesome. Thank you so much. And you've mentioned a couple of times the guide that you put together. I had an opportunity to look through that. How can people find that?
Yeah, so if you go to therealestatecpa.com, and if you hover over the education tab in the menu bar, it's one of those options. It'll say the guide to real estate professional status. It's lengthy. It's like 12,000 words. You can download it, take it with you. It's a 35-page download or something. But I put it together because I was having a lot of these conversations, and there's a lot of misinformation or just not good expectations. Because people were coming to me and they're going, well, you're too conservative if you don't think that education research hours counts. I'm like, no, I'm not. It's not me that's telling you it's not going to count. It's the IRS and the tax court that's going to deny you. And my job is to help you win audits. That's what I'm here for. And so I need to set appropriate expectations. So I built this whole guide out with all the citations. And now what I tell people is, look, if you hear multiple things, if you go to a tax advisor and he tells you something different than what you've heard today, ask for a citation. Don't feel bad about saying, where is this cited in the tax code? Or what tax court case are you referring to when you say these things? Because I can give you all mine. And if they can't, then you know something's up.
Yeah, very good. Thank you so much for that, Brandon. I'll put links to that in the Facebook group. I'll put a link to that guide, and then also to the thing from Cornell, also to that audit field guide. If there's anything else, Brandon, that you think would be good resources for people to get, kind of straight from the source, from the IRS, just send it my way, and I'll post it in the Facebook group. Thank you to everyone that attended, particularly with the little technology thing there in the beginning. Zoom never lets us down, so always go back to our trusted Zoom. Brandon, thank you so much for your time and for going about 20 minutes over here. We really appreciate it.
Yeah.
This has been great. Thank you so much.
Yeah, I love physicians. My sisters are going to be physicians, so close to the
Awesome.
heart. You guys all do great work. Keep it up. I know it's been a crazy year, but we're thinking about you.
We appreciate you saying that. Thank you. That means a lot, Brandon.
Bye,
everyone.
Thanks, Elaine.